It seems like a total no-brainer that protecting your company's secrets is a good thing. I mean, that's the whole point, right? But what if it's not always that simple? There's a really sharp paper from the Strategic Management Journal called Money Secrets that digs into this, and it asks a pretty wild question. Could stronger legal protection for your secrets actually hurt your company's value? It sounds backwards, but stick with me. We're going to break down exactly what they found.
So, here's how we'll walk through it. We'll start by locking down the central question the researchers are tackling. Then we'll get into their main theory, which they call the double-edged sword. After that, we'll look at the pretty ingenious way they set up their study, what the numbers actually told them, and then wrap up with the big picture takeaways and, of course, the study's limitations. All right, first things first. Every solid piece of research starts with a good puzzle. And the puzzle here is a big one. What really happens to a company's market value when you legally protect its trade secrets? We've got tons of research on patents, sure, but trade secrets are a whole different ballgame. They're all about concealment, not disclosure.
Yeah, this difference is absolutely key. When you get a patent, you're essentially making a deal. You tell the world exactly how your invention works, and in return, you get exclusive rights for a limited time. Trade secrets are the polar opposite. The entire strategy is to keep that knowledge under lock and key, ideally forever. So you can see why we can't just copy-paste our assumptions from the world of patents over to trade secrets.
And that brings us to the heart of the paper's argument. This central paradox. See, on one hand, keeping secrets creates an information gap that works in your favor against competitors. They don't know what you know. But on the other hand, it creates a problematic information gap when you're dealing with potential buyers. They also don't know what you know, and that makes them very wary about how much to pay. It really is a classic double-edged sword.
So this idea of a double-edged sword is a great metaphor, but how do you turn it into something you can actually test with data? Well, that's where the hypotheses come in. Let's look at the specific predictions the researchers made.
So, Hypothesis 1 looks at the upside of that sword. The prediction is that stronger trade secret laws will give a bigger boost to a firm's value, specifically in industries where skilled employees, think engineers, scientists, developers, are hopping from job to job all the time.
The logic here makes a lot of sense. If you have stronger laws, it's way tougher for an employee to just walk out the door and take critical knowledge to a competitor. And get this, a whopping 75% of trade secret lawsuits involve exactly that scenario. So these laws directly address a huge risk. They can even lower wage costs because key employees have a little less leverage. Basically, the protection helps keep the value locked inside the company.
Okay, but now let's flip to the other side of the blade. Hypothesis 2 predicts a downside. The argument is that stronger protection will actually drag down a firm's value in industries where it's already a headache to figure out what a company's technology or know-how is truly worth.
Right. So put yourself in the shoes of a potential buyer. You're looking at a company in a really complex, fast-moving industry. You have to figure out, is their success built on something real and sustainable, or did they just get lucky? Now, if strong trade secret laws are in effect, that company can legally hide even more information from you. Faced with all that uncertainty, what are you going to do? You're going to lower your offer to protect yourself from the risk.
Hypothesis 3 pushes this idea even further. It predicts that this negative effect gets even worse in industries where there's already a high risk of making a bad investment. You know, buying a company that turns out to be a lemon.
This is a direct application of the famous lemons problem from economics. The idea is simple. If buyers can't easily tell the high-quality companies from the low-quality ones, they start to get suspicious of everyone. To avoid getting ripped off, they just lower their offers across the board. Stronger trade secret laws make telling the good from the bad even harder, which means buyers will discount their offers even more, especially in markets already notorious for having lots of duds.
Okay, so we've got one positive prediction and two negative ones. The theory is solid, but how in the world do you test this stuff empirically? This is where the paper's research design really shines.
The whole study hinges on a major legal change, the adoption of something called the Uniform Trade Secret Act, or UTSA. This is basically a standardized law that different states could choose to adopt to beef up their trade secret protections. For the researchers, this is the perfect kind of natural experiment.
And here's the crucial part. States didn't all adopt this law at the same time. You can see here it happened in waves, spread out over almost 30 years. This staggered adoption is what makes the study so powerful, because it lets the researchers isolate the effect of the law itself from all the other noise happening in the economy.
So here's how they set it up. They looked at companies that were bought and then later sold by private equity firms. The treatment group are the companies that were located in a state where the UTSA law passed after they were bought but before they were sold. And the control group? Those are companies in states where the law didn't change at all during the time they were owned. It's a really clean and clever way to compare what happened. So what exactly did they measure? Well, for firm value, they used the internal rate of return, or IRR, which is a solid metric for the change in market value over time. Then, for their independent variables, they tracked whether the UTSA law passed. They measured employee mobility by looking at how often inventors moved to rival firms. They calculated industry uncertainty based on how unpredictable profits were. And they measured the lemons risk by looking at how often PE firms in an industry lost all their money on a deal.
All right, that's the setup. We have the theory, we have the hypotheses, and we have the research design. So, the million-dollar question, what did the data show?
Let's look at a super simplified version of their results. The most important thing here is how the effect of the new law depended on the industry context. And check it out. In industries where employees jumped around a lot, the law had a statistically significant positive effect on firm value. That's a direct hit for hypothesis 1. But in industries with high uncertainty or a high risk of lemons, the law had a significant negative effect on value. That's a slam dunk for hypotheses 2 and 3.
So the final verdict is pretty clear-cut. The data supported all three of their hypotheses. The double-edged sword isn't just a nice metaphor. It seems to be a real phenomenon. Trade secret protection is not a one-size-fits-all solution. It helps when you're worried about employees walking away with the keys to the kingdom, but it really seems to hurt when you're trying to sell a company in an already murky market.
Okay, let's bring it all home. What's the big takeaway here? And what are the limitations we need to keep in mind? I think this quote sums up the main contribution perfectly. We tend to assume that protecting a valuable resource is always a good thing for its market price, but this research shows that's just not true. The very act of hiding information to protect a resource from rivals can make it less valuable to buyers, because they just can't see what they're paying for. Of course, like any good researchers, the authors are upfront about their study's limitations. Their measure of firm value, IRR, has some built-in assumptions. Using patent data to track employee movement isn't a perfect proxy. And, a big one, their data is only on private equity-owned firms, which might not be representative of all companies. These are all fair points. So we're left with this really fascinating and practical question. If making the legal walls around your company's crown jewels higher can actually make them worth less in a sale, then the real strategic challenge is figuring out that tipping point. When does secrecy shift from being your greatest asset to your biggest liability? It's a heck of a question to think about.